lot of amazing things happening, and we're so gratified that you're here and that you're part of the community that is so focused on the creation of new knowledge, dissemination of knowledge in quantitative finance.
The fusion between accounting and finance is just a profound reality. The amount of material information that's useful to investors that is the normal domain of accountants is extraordinary.
Our body of knowledge is subject to constant reappraisal in light of new insights, new technology, and new data. Nothing illustrates this point better than the papers that will be presented today.
The basic idea is we want to think about these asset pricing anomalies, these variables that are thought to predict future abnormal returns. And we want to think a little bit about when they actually earn returns and when they don't.
So when I look at this paper and my discussion that follows, I'm going to really take it from three different perspectives. And the first is coming from this efficient market hypothesis perspective.
Which of these anomalies are redundant? Do we actually need all of these anomalies? Can they kind of be thought of as together? And on the converse, are there synergies between anomalies? Can some of these together become even more powerful than they are on their own?
And I think if you kind of keep that in mind, you can easily, square that with what the real-world evidence is.
We now invite the authors of these winning papers who are here with us today to join us at the podium to accept their awards. Congratulations.
Another trend has been the move towards more fair valuation, recognizing, the standard setters believe anyway, that the management is the group with the private information. Let them do the valuation. They're best at it.
The funny thing about all this to me is that the most valuable assets that companies have, their people, intangible assets, the R&D, et cetera, none of that is fair valued. Actually, none of it's even on the balance sheet.
Lo and behold, it was very easily discerned that it's not as easy to mislead market, and therefore the prices are not mechanically linked to the non-GAAP earnings.
So that fact that elasticity here is higher than 1 makes the value of intermediate inputs a hedge that ultimately reduces the risk of value added relative to the risk of the output.
I would argue that kind of one explanation here is that we're sort of correcting for the ills of the three-factor model. So it's important to know that that's part of what's happening with profitability.
It is our great honor and privilege to recognize the pioneering work of Ray Ball and Phil Brown with the 2019 Wharton-Jacobs Levy Prize for Quantitative Financial Innovation.
An empirical evaluation of accounting income numbers opened another research door, one that's had a particular impact on investing and led to much fruitful investigation and practice in the many years since its publication.
Their findings were revolutionary. Earnings and stock prices were most definitely correlated. While stock prices generally anticipated earnings announcements, they continued to be affected after the announcement. We are proud to award the 2019 Wharton-Jacobs Levy Prize for Quantitative Financial Innovation to Ray Ball and Phil Brown.
It's not a matter of just looking at public information and trading on it. You actually have to be better than the market to beat the market. So in terms of earnings, it's not enough to be a good forecaster of earnings. You've got to be a better forecaster of earnings than the market.